Valens Research, Uniform Financial Analytics.
Right, Tencent, who has obviously been in the news, one of the largest, if not the largest, internet company in China. And Tencent, right, they have everything from, basically a payment platform to a chat service to gaming, etc. And the really powerful thing when we look at Tencent is a couple things pop out when we look at the uniform accounting data. Now, of course, it's been in the news. Unlike Alibaba, it hasn't gotten quite as much trouble with Chinese regulators. It does have a gaming component to its business that's been impacted. But right, as opposed to something like Alibaba with Ant Financial and everything else, and with Alibaba's listing in the US, it's gotten a bit more dicey. Since Tencent's primary listing is in Hong Kong, it hasn't quite so much flack, and also because it's done a better job playing ball. But a couple of things jump out immediately when we look at Tencent on a uniform accounting versus as reported basis. The first is this company is making way more money than as reported metrics reflect. You would look at this company on an as reported basis because you would say, how possibly could this be one of the 10 largest companies in the world based on enterprise value? It's a 7% return on asset business. That's an abysmal company. I guess apparently that just copying US IP isn't that valuable. The reality, though, is you'd see with Tencent, the innovation that they have had and the, if you will, moats that have been drawn around China for anyone to compete with them, give them phenomenally high return on assets. And even more than that, when we look at valuations, what we can see is, well, people might see, even if they knew about these high return on assets, they might also see, though, that Tencent is trading at a 27 times multiple and say, well, the market's already pricing in a lot of this company's strong growth and profitability. But what we can see using uniform accounting is this isn't a low return, high PE business. This is a high return, high growth, low PE business. I mean, a 17 times multiple for a company that's growing this fast, for a company that has this kind of economic moats, that has this kind of scale, Tencent looks cheap. And we can see that with the white and blue bars, with the white bars for asset growth and return on assets too. This is a company who has only grown below 20% a year 3 times in the last 15 years. And the market is pricing that growth to be 12% a year going forward. And the market's also pricing return on assets to fall to levels that Tencent has never seen historically. Right? Tencent has never had return on assets that was at 55%. It's never had asset growth this low. If it can sustain higher asset growth and return on assets is somewhere between 75 and 100%, there's massive upside for this company. Now, mind you, we're not recommending Tencent. We don't get into the business of recommending Chinese stocks because there's a lot of other dynamics that are going on for these businesses. Issues that are around regulation, issues around quality of accounting, issues around getting access to liquidity that you can believe that the listings will remain here and everything else. But if you believe in Tencent, if you believe it is a resilient business and that it can keep on just growing even less than it has the last 10 years, right? You've got a company that is a double. You got a company that's this massive that could still double, but you'd only know to have that confidence if you realize how profitable this business was, how strong its growth really is, and how cheap it is, which you can only see using uniform accounting. You can't capture that looking at the as reported metrics.
Valens Research, the world's leading source for uniform financial analytics.